Right, hi guys. So let's talk about what we expect from the stock markets in 2022. So 2021 ended with a bit of a bang. We ended 2021 up 26.9% on the S&P 500. But 2022, we're starting with a bit of a thud, which is not surprising because after a strong rally towards the end of the year, a pullback is not unsurprising. So again, if you take a look at the S&P 500, you can see our wave patterns as usual. We've got that wave up, and a wave down, a wave up, wave down. And towards the end of last year, we had a strong wave up to close the year up strong. And of course, at the beginning of the year, now we're starting with a wave down. But the overall trend of the S&P remains on a very nice uptrend. And now we have waved down to the 50 moving average support, which is this blue line over there. Now you can see the previous two retracements, the S&P actually waved down more towards the 100 moving average, which is this orange line. You can see this 100 moving average has been a pretty strong support. So I'm not surprised that we get a bit more of a correction down to that 100 moving average where we find support before the next wave up. But again, the question is this: for this year, do we expect the uptrend to continue? Do we expect this to be another one of those many corrections, or do we expect something bigger like a bear market? So we're gonna discuss this thesis in this video. So far the S&P is down 3% from its highs, which is not big a deal, right? So I'm not too surprised if we drop another 2% for 5% correction. That's still a very healthy correction in this bull market. That's the S&P 500. Now for the NASDAQ, we've got a deeper correction, mainly because again, this market correction has been blamed on rising treasury yields, where the treasury yield rose from about 1.5% to now like 1.7%. So treasury yields are the long-term interest rates. When long-term interest rates go up, it affects technology stocks the most, specifically high growth, high price technology stocks, because it reduces their valuations. But in fact, it doesn't affect companies that are generating positive free cash flow that much. So you can see the Dow Jones is not that affected, S&P relatively not that affected, but the NASDAQ has been hit harder. So if you look at the NASDAQ, which contains many of these tech stocks, high-flying tech stocks, you can see is down a bit more. And again, you can see the 100 moving average has been a pretty strong support so far. So we hit a high over there, and we had this like wave down, and it's been consolidating, and now another wave down, again back to this 100 moving average. So again, question is, will this 100 moving average hold? Will this support hold? If it holds, then we'll get the next wave up and the uptrend continues. Or will it break this 100 moving average? Are we in for a deeper correction on these technology stocks, specifically the high-flying technology stocks? Remains to be seen. But again, for now, the NASDAQ and the S&P, again, so far remain on an uptrend. As long as the 50 moving average, this blue line over there, is above the 150 moving average, it tells you the medium-term trend is still up. As long as the price is above the 200 moving average and the 200 is sloping up, the long-term trend is still up. So for now, the uptrend is still intact, but the big question is, will we see a reversal in the trend this year? So is 2022 going to be a bullish market, or is it going to be a bearish market? Let's explore both points of view. Let's explore both arguments, and at the end of it, I'll tell you my perspective and you can share your perspective as well. And we see whether it matches. So let's begin with the bearish perspective, the bearish argument. So there are a few reasons why bears think that, we're going to crash this year or in the years to come. And the main reason that bears are giving is that, the easy money is over. The easy money party is over. Now, if you think about it, from the depths of the COVID crash about 2 years ago, the market is up over 100%. And bears would argue that the only reason the market is up is because the Federal Reserve has been pumping so much liquidity into the system. They've cut interest rates all the way to zero, and the Fed has been buying up $120 billion worth of treasuries and mortgage-backed securities every month. Essentially, the Fed has been printing money like crazy, flushing the system with so much liquidity that this has actually been propping up the markets because of all this easy money. But now what's happening? Now the Fed is saying, wait, because of high inflation coming, we have to reduce our asset purchases. We're going to stop printing money. So we're going to end the quantitative easing. We're going to raise interest rates. And bears believe that once they do that, once they take away the easy money, once they raise interest rates, the whole market is going to crash. So that's the bearish argument. And the Fed is looking at increasing interest rates at least 3 times this year. Now it's like almost 0%, but they intend to increase it to maybe 0.5, 0.75% and reduce their asset purchases and end the quantitative easing by March. So that's the first bearish argument. The second common bearish argument that you hear is that people say that, you know what, the stock market is just too expensive. The market's in a bubble. And a lot of people who are saying that are looking at it from a PE ratio perspective. They are looking at the PE ratio of the S&P 500 index. Now, what's the PE ratio? It's the price divided by earnings. And what they're saying is that the PE ratio of the market is extremely high relative to history and is unsustainable. So let's take a look at this chart. This is, by the way, from gurufocus.com. It's a screenshot that I took, so I'm going to credit that to them. And if you look at the Shiller PE ratio, which is the cyclical PE ratio, you can see that currently the PE ratio of the S&P 500 is 38.8 times earnings. Now, is that high? People say, yes, of course it's high. Look at the history, okay? So if you take a look at the last 20 years, the average PE ratio of the last 20 years was 25 times. So at 38 times, we are 50% above the 20-year average. If you take the last about 50 to 60 years, which is the longer term average, that's about 17 times PE ratio. So if you base on the long-term PE ratio, we are 124% above the long-term average. And that's why they say that the market is crazy expensive. It has to come back down to the average PE of 25 times or even 17 times. So that's a second bearish argument. The third bearish argument is that, you know what, the market has gone up double digits in the last 3 years, so a bigger correction is due. So sure enough, if you take a look at the markets over the long run, so this is the S&P 500 returns over the last 71 years. And you can see that in the long run, the market goes up certain years, it goes down certain years. It doesn't go up every single year. But the good news is the market goes up a lot more than it goes down. And the market can't go up every single year. If you take a look at the last 3 years, 2019, the market went up 28.9%, double digits. In 2020, the market went up 15%, double digits. And last year, 2021, the market went up 26.9%, double digits. So the market has gone up double digits in 3 consecutive years. And that's very, very rare. Because if you take a look at the long-term average of the S&P 500, on average, it returns, on average, in the last 70 years, about 10% a year on average. And in the last 10 years, the S&P has returned about 13.5% a year on average. So getting a 20% return a year or 15% return a year in the last 3 years, it is not normal. It is way above average. And if you look at statistics, you know that it can't do that every year. That what the market gives, it has to take back eventually to get that 10% average. So bears would argue that, hey, you know what, 2022, I think it's time that the market gives back what is taken, or rather the market takes back what is given so much of in the last 3 years. So a bigger correction is due. So that's the third argument for the bears. The fourth argument for the bears, which is the last argument, is that, hey, from a technical perspective, from a technical charting perspective, the market looks overextended looking at the long-term chart. So again, if you look at the S&P 500 on a 10-year chart with monthly candles, the price looks a bit overextended from its moving averages. So remember that markets don't go up in a straight line. Like I keep saying, it's got a wave up, wave down, wave up. It moves in a cycle. And eventually it always comes back near to its moving averages, which are these lines that you see over there. So if you look at the last 10 years, you can see the big waves, right? You can see again the wave up, wave down, wave up, wave down, wave up, big wave down in 2020 because of the COVID crash. And since then, we've been waving up, right? It's a wave up, right? It's a waving up, all right? So eventually it's got to wave down near the moving averages. So bears are saying, you know what, we're getting a bit overextended. It's kind of like a rubber band, right? If you pull the rubber band too far from its center, it'll snap back eventually. But then again, sometimes the price can remain there and the moving averages could also catch up. So that could also happen. So far the bears have 4 arguments. Now, before you get all depressed and think, oh my God, we're going to die, the market's going to crash, I'm going to get out, right? Hold on. Let me present the bullish arguments now. So now the bullish argument. Bullish argument number 1, the stock market is not expensive from a PEG ratio perspective. Let me say, what does that mean? Now, the trouble with PE ratio is that it can be very misleading because PE ratio doesn't take into account the earnings growth. So let me ask you a question. So let's imagine we've got a stock with a PE ratio of 10, price to earnings ratio, and a stock B with a PE ratio of, say, 30. Question, which stock is more expensive? Some people would say, of course, B, because B is a PE ratio of 30 times earnings, right? Whereas A is only 10 times earnings. Wrong. Because it depends on the growth of the earnings that makes a difference. What if I told you that stock A has a PE ratio of 10, but the earnings of the company are growing at, say, 5% a year? And stock B, PE ratio is 30, but the earnings of stock B, the earnings are growing at 60% a year. Now, which stock is more expensive? And the answer is stock A is now more expensive, stock B is cheaper. So roughly, you have to look at what we call the PEG ratio. PEG ratio is a ratio where you divide the P ratio by the earnings growth rate. So in other words, for stock A, P ratio is 10 times, and you divide that by the growth rate, which is 5%, that gives you a PEG ratio of 2, which is extremely expensive. Okay. For stock B, what's the PEG ratio? The PEG ratio will be the PE ratio, which is in this case 30 times earnings, but the earnings are growing at 60%. So you divide it by 60, you get a PEG ratio of 0.5. So from a PEG ratio perspective, you can see that stock B is very cheap and stock A is very expensive. So that's what PEG ratio means. Now, so what's a high PEG ratio? What's a low PEG ratio? Now, my rule of thumb is that the PEG ratio should be no more than 1.5. No more than 1.5, right? So in other words, the growth of a stock, okay, or rather, the PE ratio of a stock should not be more than 1.5 times the growth of the earnings. In other words, if a company's earnings are growing at, if the company's earnings are growing at 10%, then the PE ratio should not be more than 15 times. Then I would say it's a fairly priced stock. Now, with that foundation, let's take a look at the overall market, the S&P 500, the 500 biggest companies in the market. So again, the bears would argue that the PE ratio is now very high relative to historical PE ratio, like in the year 2000, for example, or earlier than that. But that's not accurate. Why? Because the companies that make up the S&P 500 today are totally different from the companies that made up the S&P 500 10, 20, 30 years ago. It's a totally different animal. So for example, 20 years ago, the top 10 companies that make up the S&P 500 were General Electric, ExxonMobil, Pfizer, Citigroup, Cisco Systems, Walmart, Microsoft, and AIG and Merck, and Intel. So you can see that the majority of the companies that made up the market were brick and mortar companies. And most of these companies, what was their earnings growth rate? Their earnings growth rate was between 8 to 10% earnings growth a year. So think about it. If these companies are growing their earnings at, say, 10% a year, what should the PE ratio be? The PE ratio should be, I told you, not more than 1.5 times. More than the earnings growth rate, right? So what's 1.5 times 10%? 15%. Can you see what I'm saying? So historically, the PE ratio of the index should be 15%. Now, if you look at the dot-com bubble, the PE ratio of the market went up to 43 times. 43 times. So that means that at that time, the PE ratio of the market was 43 times, and earnings were growing at 10%, which means the PEG ratio during the dot-com bubble was 4. If you take 43 divided by 10, it's about 4.3. That's why the market was insanely overpriced back then. But today, it's not the same thing. Why? Because today, what are the companies that make up the S&P 500? In fact, the top 5 companies make up 22% of the weight of the S&P 500. And the top 5 companies that move the S&P would be Apple, Microsoft, Alphabet, Amazon, and Facebook. Now, it's called Meta. Now, if you take a look at these companies that make up the S&P, what's their earnings growth rate? Their earnings are not growing at 8 to 10% like the old companies. These companies, their earnings are growing at double digits. For example, in the last 5 years, Microsoft has been growing its earnings on average 25% a year. Apple 22% a year, Amazon 100% a year, Facebook 50% a year, and Google growing its earnings at 20% a year for the last 5 years. Okay? So if you take a look, you can see that the majority of the companies that drive the S&P, their earnings are growing at about 25% a year. So at the current PE ratio of 38 times today, which I showed you earlier on, what's the PEG ratio? The PEG ratio would be 38 times PE ratio. And if you divide that by 25% earnings growth of the majority of companies that drive the S&P, you get a PEG ratio of about 1.5 times. So that tells you that the market today, based on a PEG ratio perspective, is not that expensive. I mean, it's not cheap, but it's not that expensive either. As compared to 20 years ago during the dot-com bubble, where the PEG ratio was a freaking 4 times. So that's the first bullish argument. Don't be misled to think that the market is expensive, because it's not expensive. There are certain pockets of the market that are expensive, that are in a bubble, but that bubble has more or less burst. These are the speculative growth stocks. But the overall market is actually not that expensive if you dig deeper into the numbers. The second bullish argument is that actually the stock market is very cheap if you compare it to the bond market. You see, whether something is expensive or cheap is always relative to something else. For example, a $100,000 car, is it cheap or expensive? It depends. For example, in the US, in the UK, Australia, a $100,000 car is considered pretty expensive because you could buy a car for 20, 30, 40, 50 grand, right? But in Singapore, where I live, a $100,000 car is dirt freaking cheap. Because in Singapore, a BMW 3 Series is $150,000. So in Singapore, a $100,000 car is cheap relative to the other cars in Singapore. Now, the same thing with stocks and bonds. So again, understand that there's a lot of cash and liquidity in the markets. And institutional investors and the big money managers, they have to park the money somewhere. Money has to always find a home, because if they hold the money in cash, it's losing 6% a year on inflation. right? Money is losing value because of inflation, so they're going to put the money somewhere. And they're always deciding between stocks and bonds. If stocks are cheaper, they'll buy more stocks. If bonds are cheaper, they'll buy more bonds. It's always between these two things. So right now, are stocks expensive? No, they are very cheap relative to bonds. So how do you know? Well, we look at two metrics. The first thing is we look at the S&P 500 earnings yield. And currently, the earnings yield of the S&P 500 is 3.7%. Now, how do you get the earnings yield? It is actually the inverse of the PE ratio, right? If you take the PE ratio of the market and you invert it, it becomes earnings over the price you pay, and we call this the yield of the market, and it's now at 3.7%. How about the bond market? If you look at the 10-year Treasury bond market, currently, as of this chart, the yield on bonds, 10-year bonds, is 1.6%. Okay? Now, as of a few days ago, it did rise more to about 1.7%. So let me just update this. It's now about 1.7%. But still, you can see that S&P 500 or stock markets are yielding a lot more than bond markets. So what does this actually mean? What this means is that if you were to invest in stocks, it means that on average, for every $100 that you invest in the stock market, you'll be getting $3.70 return a year. That's what it means. And of course, this earnings, this $3.70, grows over time because the stocks, their earnings are growing. Whereas if you invest in a bond market, you get a 1.6% yield, which means for every $100 that you invest in bonds for the next 10 years, you're getting $1.60 in profit a year. So what would you rather do? Would you rather put your money in stocks and get $3.70 a year and that's growing? Or would you put your money in bonds where you're getting $1.60 a year? Duh! Obviously, stocks are the better deal, right? And that's why as long as the earnings yield on the S&P is above the 10-year Treasury yield, money would always rotate into stocks than bonds. And that would continue to fuel the stock market rally for years to come, as long as we have got this metric, right? Now, during the dot-com bubble, when the market crashed, was it this case? No. You can see that in 2000, it was the opposite. At that time, stocks were expensive relative to bonds. At that time, you can see that the green line, which is the bond yield, was about 7%, right? 7%. And the stock market S&P yield was about 3.8%. So at that time, you can see that bonds gave you 7% return, stocks gave you 3.8%. So it makes sense that at the time, the stock market had to collapse because it was more expensive than the bond market. And that's just not the case today, okay? So that's a second argument for the bulls. All right, third argument for the bulls is that right now we are seeing negative real yields. And negative real yields are very bullish for the stock market as long as real yields remain negative. Let me say, what the heck is this mean? What is negative real yields, right? Okay. Now, first, let's take a look at inflation. Now, we know that recently inflation has gone up really high, way above the 2% target set by the Federal Reserve and above the 2% inflation rate, which is the historical average, right? So as of November, it was reported that inflation is up 6.8%. This is the inflation rate, okay? So what does it mean? It means that basically, if you hold cash, you're losing 6.8% a year on your money if you don't invest it, okay? Now, if you invest it into bonds, like I said, if you look at a 10-year bond, it's now yielding 1.7%. So what does it mean? Think about it. If you take your money and you invest into bonds and you've locked in your return for 10 years, which means for the next 10 years, you're getting 1.73% return on your money. But your money is losing 6.8%. So what is 1.73 minus 6.8? That's minus 5%, which is negative. So we call this negative yields. So in other words, if you buy bonds today, you are guaranteed to lose 5% every year. This is what we call negative real yields. Why? Because inflation is higher than the treasury yield. Usually when inflation goes up, treasury yields should go above inflation. But now it is not. Inflation is higher than treasury yields, creating this negative real yield. Now question, is this common? No, it's not. It is very rare. And has this happened before in history? Yes. In fact, this phenomenon of negative real yields has happened about 1, 2, 3, 4, 5. It has happened 5 times in the last 100 years. And it's happening now as well, as you can see. So if you look at this chart, the blue line is inflation. And the orange line is the 10-year treasury rate. So again, usually the 10-year treasury rate should be above inflation. That's a normal market, right? But when the blue line goes above the orange line, that is an abnormal market. Negative real yields, right? So you can see right now it's way above. The blue line is way above the orange line. Now, when did this happen in the past? It happened in the 1980s over here, negative yields. 1970s, right? Negative yields. 1950s, negative yields. 1940s, negative yields. And 1917, World War I, there was a huge difference as well. Now, question is, during those times when this happened, what happened to the stock market? Was it bullish or bearish? Let's take a look. So in 1917, when we had negative real yields, in 1917, in the next 2 years, the Dow Jones gained 80% from 1918 to 1990, right? In 1942 to 1946, which is this time over here, the Dow Jones gained 120% during that period. And in 1949 to 1956, which is this period over here, the Dow Jones gained 230%. Now you may be saying, Adam, why are you using the Dow Jones and not the S&P 500? Because at the time, the S&P 500 did not exist yet. The S&P 500 was only introduced in the late 1950s. So the only index at the time was the Dow Jones, right? That's the reason why. Now, what happened in the 1970s when we had negative yields again? So in 1975, when the negative real yields hit minus 5.2%, like it is today, the S&P 500 gained 22% in the next 12 months. And in the 1980s, when negative real yields reached minus 4.9%, the S&P 500 gained 14% in the next 12 months. So based on historical data, it appears that negative real yields are actually bullish for the stock market. So again, what's the logic behind this? The logic is that as long as real yields are negative, people find that it's a guaranteed loss to put their money into bonds. And hence, they'll keep rotating the money into stocks and driving up the stock market. And also, negative real rates are actually stimulative for the economy because they encourage credit growth and they help governments finance their outstanding debt. Because inflation reduces the real value of the debt. So in other words, it's the way that the US government is the way they inflate away their debt. Because with inflation, their debt becomes smaller and smaller over time. Bullish argument number 5. Stocks and interest rates trend in the same direction in the long run. See, a lot of people think that rising interest rates is bearish on the stock market because with high interest rates, it increases the interest cost of companies. It reduces the company's borrowings and investments. And increasing interest rates reduces the valuation of stocks because it increases the discount rate used to discount future cash flows of companies. But in reality, you will realize that stock market and interest rates actually trend in the same direction. Why? Because what causes the Fed to increase interest rates? It's accelerating economic growth. So when the economy is accelerating and that creates inflation, that causes the Fed to raise interest rates, which means interest rates are rising when the economy is accelerating, and that leads to higher consumption and higher earnings growth of companies. And as long as you invest in fundamentally good companies that are actually generating profits, it is bullish for those companies. But if you invest in companies that are losing money, that are unprofitable, that are pumped up by speculation, then that is bearish for those companies. So if you invest in companies like, C or Teladoc or DocuSign, a lot of these companies don't actually make money, right? Their valuation is pushed up by future earnings, and they will be the most affected by rising interest rates. But if you look at companies like Microsoft and Facebook and Google and Amazon that actually generate cash today, higher interest rates are actually bullish on those stocks because they actually make money. So if you take a look at history, you can see again, stocks and interest rates actually trend in the same direction over the long run. You can see the blue line is the Fed funds target rate, which are short-term interest rates of the Fed, and the black line is the S&P 500. And you can see as the Fed increase interest rates, what happened to the stock market? Stock market goes up. When the Fed increases interest rates, stock market goes up. Fed increases interest rates, stock market goes up. So don't be too worried about the Fed raising interest rates because historically, the market goes in the direction of interest rates increase. Right, so final bullish argument number 6 is that, the stock market, despite the recent correction, it still remains on an uptrend. As long as the market remains on an uptrend, prices will continue going higher because the trend is your friend. So again, if you look at the S&P 500, you can see that as long as the 50 moving average, which is the blue line, remains above the 150 moving average, and prices remain above the 200 moving average, and the moving averages are sloping up, guess what? The path of least resistance is up, all right? So as long as we have got the moving averages sloping up, as long as we have got the moving averages in sequence, prices remain on an uptrend. Of course, if the trend reverses, the 50 crosses below the 150 and the 200 moving average slopes down, then we will be in a bear market. But for now, the trend remains up. And supporting the market, we have growth. So US GDP is expected to grow at 3.5% this year. S&P 500 corporate earnings are expected to grow at a lower rate, but still grow at about 6.7% for 2022. So we still expect growth from the companies in the S&P 500. Specifically, again, the S&P is very much made up by the technology companies, a big chunk of the weightage, right? And tech earnings, I still expect double-digit growth driven by the continued long-term secular trend towards the digital economy. We are continuing to digitize, and this will benefit our tech companies. And especially the next catalyst for growth would be the transformational shift into the metaverse. And that will benefit companies like Nvidia, like Apple, in China, Tencent, and Meta, and Microsoft, and so on and so forth. So there's going to be a lot of growth in earnings coming from this transformation into the metaverse and the Web 4.0. So now that you've seen the bearish arguments, which are about 4, and the bullish arguments, which are about 6, what's your take? Do you think the market will end up bullish or bearish this year? Leave your comments below. Now, if you ask me, my guess would be barring any unforeseen exogenous event, like for example, China attacking Taiwan, or another deadly virus that's going to kill people in 24 hours, or aliens landing, all right? So barring any of those things, I expect that this year the market would still end up, All right, still make a gain this year, although not double digits. So I expect a low gain this year, but a gain nonetheless, barring any, again, exogenous event. Again, having said that, always remember that as an investor, as a trader, prepare for all scenarios. And I tell people that, you know what, again, our job as investors is not to predict where the stock market will go in the short term, because it is impossible to predict with 100% certainty. But our job is to invest in the fundamentally best companies in the market and to be well diversified so that no matter what happens, high interest rates, low interest rates, high inflation, low inflation, no matter what happens, our portfolio will keep growing over time as our companies grow in value with minimum volatility. So I hope you enjoyed this. And again, leave your comments below. I'm curious to find out what you guys think. And may the markets be with you. And I look forward to seeing you in the next video. And remember to subscribe for more videos. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.